Very good afternoon, everyone. Welcome to today's uLaw webinar. The topic for today's webinar is Disbursements Demystified. Okay. Today's webinar is accredited for 1 hour of professionalism CPD credits in the provinces of Ontario, British Columbia, and New Brunswick. So please do use the title Disbursements Demystified at any time within your CPD portal or your Law Society portals, and you should be able to get your 1 hour CPD after you've attended the whole session. Okay. Simple housekeeping rules. Please do use the chat window at all times if you have any questions. We have seen that the quality of the audio really varies if you're using internet, and if that's your situation, if the quality is not that great, we highly recommend that you dial in to the phone numbers, local numbers that have been provided in our email invitation to you. Like all other uLaw webinars, today's webinar has this specific agenda. We're going to be talking about disbursements, a very important component of kind of really the day-to-day activities of a legal firm. A very important component which can contribute to either the profit or loss of a business's top line, bottom line, depending on how best you manage these. And we're going to talk about some options that you have so that you can take the right measure to avoid not being able to recover these payments from your clients, such as using the trust account to being able to pay for these disbursements. And of course, we're going to talk about how you would use the general account to pay for disbursements, what are disbursements to begin with, of course, and some types and examples. And hopefully you can take away from today's meeting some tips and tricks of the trade that allows you to better manage and maintain proper bookkeeping of the disbursements and the expectations, if you will, from the law societies of the different provinces in regards to how best you record and report these disbursements back in certain templatized documents. Okay. Once again, for our friends who just joined us, Disbursements Demystified is the name of today's webinar topic. It has been accredited for 1 hour of professionalism CPD credits in the provinces of Ontario, British Columbia, and New Brunswick. The webinar is being recorded and will be available on our YouTube channel early next week. Okay. Beginning with what is a disbursement, of course, I've conducted these webinars a few times in the past. And it's such an interesting topic to talk about, even if I'm kind of repeating myself across these webinars, because it still is a very important factor, if you will, within a legal office's day-to-day business, an important factor that you have to consider as you work on your client's files and matters. It's an important factor that can contribute, as I mentioned earlier, to your bottom line. And it starts off by representing it as a top-line component, right, as part of your invoice. But in a layman's term of what a disbursement really is, it's an expense that you incur or pay for on behalf of the client, or specifically a client's file, and that's pretty much it. It's not an office expense. It's not what you pay for rent, and it's not to run your business. It is essentially, very specifically, an expense that you as a legal firm pay for on behalf of a client's file. And of course, this payment of this expense is recoverable. And that's the biggest difference between an office rent and what you're paying on behalf of a client. Of course, what's necessary to back this up is a well-drafted retainer or an engagement letter that clearly states the rules and the guidelines of how best you recover these expenses. Yeah. From an accounting perspective, because that's critical, because this component or factor translates into law society compliance documents as part of the overall compliance needs from the law societies. And from an accounting perspective, it is essential for you, whether you're a sole practitioner or if you're a legal firm with multiple colleagues in it, that you have to find a way to record these transactions and have it in your bookkeeping system, software, or otherwise, so that you can best balance the accounts when you actually do spend, invoice, for you to be able to recover that expense. Bottom line, track them by recording them on time. Include them as part of a recoverable pathway, and we're going to talk about the different pathways that you have of how best you can recover these expenses or disbursements, and of course the last stage is to be able to recover it itself. The next question really is, all right, that's great, so I'm paying for this on behalf of my client, and now what, right? How do I manage these disbursements? This is a question or a specific topic that we actually made a presentation to certain colleges and universities where there were a lot of questions around the rules and regulations of disbursements, how best to manage them, and we really wanted to include it as a slide share and talk about it. So even for those seasoned individuals, hopefully they'll kind of preaching to the choir here, there's something new for you to pick up. As a legal firm, given, of course, the opportunity that you have both the requirement and the responsibility to utilize what's called as a trust account, which necessarily you use to take funds from your client in advance of executing or completing work for a specific file. And I'm sure we all know this. As part of that disbursement expense bookkeeping, there's one of two or three ways in which you as a legal firm can best manage how you pay for these expenses on behalf of a client and recover them, right? So the first step that we want to necessarily advocate for, especially if you do have a trust account, is to being able to exercise and use the trust account for pay for these expenses. The second route, of course, is, let's say you do have a retainer, but you're still going to pay for these disbursements out of your general account, then the pathway there for you to invoice, but then don't wait for the client to pay you. You can actually do a trust transfer to recover that expense. And the third route or pathway would be for you to not use the trust account at all and purely depend on paying for these expenses ahead of time using your own operating account, generating the invoice, but in this case, waiting for your client and hoping that they would pay you on time within what's been agreed in that engagement letter. Okay, so those are kind of the three pathways that we've seen most often with regards to disbursements. And we'll come back to these three pathways in our later slides, but there are certain common elements and certain common practices that you may have to follow to ensure the details that go into the transactions themselves are well recorded. In talking about details, we want to talk about what goes into these details and why are we capturing these details, okay? One of the most fundamental data element, I like to call them, is the date as to when this disbursement was paid for. So let's say there's a court fee, there's an application fee, this could be a real estate matter, this could be a criminal matter, LATB. Each and every area of practice has its own unique disbursement needs, costs, and reasons. So we first captured the date when this disbursement was paid. The second question, or the detail that you want to capture, or data element that you want to capture, is how was it paid? Okay, again, this is in no specific order. This could be in any order you choose to, but ensuring that you capture them so that you can depict them or report them in a certain format that's well laid out for you to record and report. We record the date when this disbursement was paid. How was it paid? So did you pay this out of your trust account? Did you pay this out of your general account? Okay, that's the first question. If you did pay this out of your trust account, what was the method used? Typically, you see within a trust account, people use trust checks. You know, if it's a court fee or an application fee, of course, when you're signing up to work with a financial institution, of course, remember to ask them for what would cost for you to have checks out of the trust account. Okay. Often we work with young legal entrepreneurs who start off by creating the trust account and the operating general account, have a credit card. But when we talk about trust checks, they're like, we never spoke about that. So they always have to go back to the financial institution to purchase them. So something for you to think about in terms of having trust checks. That's one method. Of course, you may have other methods to use as well. If you are using the general account to pay for it, then of course there's a variety of methods of payments. This could be starting with your own personal money that you've used to pay for it, which means that there's one more step for you to recover from the client and then pay yourself for that. That's how you as an individual, especially in a sole practitioner, are able to recover that expense that you paid for on behalf of your business. But again, don't want to over confuse you. Let's say general account, you use your business credit card, right? That's one method of doing it. That's one of the details. When, how, including the method. And an important question, what was the reason? We mentioned this earlier, court fee, application fee. This really allows capturing these details. Of course, there's definitely a method to the madness. Each and every data component has a certain significance as to why it's being captured. Right? One is, of course, the Law Society guidelines and the bookkeeping guidelines themselves. But when you look at capturing the reason why that expense or disbursement was paid for, when you actually reconcile your books, which really is comparing your bookkeeping numbers and transactional itemized, comparing it with your financial institution's itemized transactions, it will be easier for you to have your own internal reconciliation and for you to reconcile the books when you know the reason for it. Because the banks, not necessarily all of them give you all the details. So let's say there's a court fee, right? And it's $260. Certain financial institutions may just give you a little description which says $260 being withdrawn from the bank account. Unless you've had a way to document that that $260 was towards a court fee, you might just find it hard to understand what that was for. Now, take that $260 and maybe you had multiple transactions, $260s. This is where you need to capture the next detail, and that is the specific client and matter or file for whom you have sent all of this. When you pay for this disbursement, how it's paid, the method used, the amount that you disbursed, including taxes or not taxes. Because if it's a court fee or an application fee, you may not have taxes. But if it's a fax or if it's a travel mileage, there could be other factors, as I said, or other reasons for these disbursements. They may include a tax component in them. And you need to, basically based on the retainer engagement letter, determine those factors. So finally, it comes down to the client and the specific file. So if you have these details, and let's say you're reconciling at the end of the month, and you're looking at your own bookkeeping ledger, and you're comparing it with the financial institution's statement, if you see a couple of $260, one on the 6th and the other on the 18th of May, provided that you've captured these details, it's going to be very evident and simple for you to reconcile that, oh yes, the 16th was a $260 pay for Peter Piper for a court fee, and the 18th of $260, without taxes or with taxes was paid for Gerald Butler for a totally different matter. Okay? So it's easier for you to reconcile that. Now, if you do consider using the general account, as I mentioned earlier, these disbursements may not have a tax component, so that's important for you to consider. But if it is a general operating account that you've used to pay for it, now you go back to those two different pathways that we discussed. One is you may have money in the retainer, which now you can do a pending trust transfer, as they call it. So invoice, and then do that eligible trust transfer for that specific amount from the trust account to the general, which means you've actually earned the right through that invoice, earned the right to recover that disbursement from the trust money that you already have. Okay? Or if you're simply operating out of the general account, or if you're not going to be moving money from trust to general, then of course you have to generate the invoice, send the invoice to the client, and of course within your days of sale, whatever are your terms of payment, you wait and follow up for the client to pay you for that disbursement, so that then you can deposit that method of payment that you received the funds into your bank's account. That's when you recover. You paid $260, you've got $260 back from the client, and at the end of the day, unless there's a specific reason, most of these disbursements, you're not looking to make money out of these disbursements. You're ensuring that at least you don't lose that $260, you at least recover it so that it doesn't add to the bottom line and finally end up being a loss for the firm. That's what this whole dance is all about. Okay. And we spoke about the example of $260, what you've paid, you're hoping to recover it. So really, it's not your money to make. And let's assume you're not making a profit or a loss margin. At the end of the day, this is not your money to keep. It was a transactional item. I wouldn't call it a favor, but it's something of a responsibility for you as a legal firm to pay these disbursements, because the client's not going to go pay an application fee or a court fee. So you take that responsibility on yourself, and you're the good person here to have paid it in advance. But to safeguard your own financial interests, you need to be smart to understand how best you can recover these expenses in time. And then there are a couple of hurdles that we've often come across when we work with our legal friends around why they don't sometimes recover it in time. And the number one issue that we often find is they don't have or haven't really recorded that particular transaction as and when it happens. And it's not so much a software issue, it's more a small issue with having the right tools and the mindset and the discipline to do it as and when it happens. Right? So one thing we often advocate is whether you use an Excel sheet to record it, write it in a paper, or use a legal accounting software to record a transaction, please do make it a point to capture and record a transaction that has occurred in real life or is going to happen as per a certain time schedule as soon as you know that it's going to happen or it has happened. Okay? Because that way it's fresh in your mind and you don't have to worry about it after the fact. All you have to worry is ensuring that you've now moved on to the next phase of recovering, which is generating the appropriate invoice and taking any of these pathways to recover them. Okay? And hence we ask the question, if this was not your money to begin with, and you have to go through all these paperwork to recover it, why not use the trust account to pay for it and keep it simple? So you go to the client, ask for a retainer that includes a certain fee component and a certain disbursement component. Sometimes, if you know what you're actually dealing with, and if it's your 100th client or 100th, criminal matter, and you pretty much know the DNA of what's going to happen, you pretty much know what the disbursement typical costs are going to be, and hence that's added as a component of the retainer. And this could be for any matter, small claims, LATB, family, etc. Right? So there could be various different, like in a real estate transaction, I'm sure you can appreciate, there are well-defined disbursement components. Some big ticket items and some small ticket items as well, right? But if you do appreciate it, and then include that with some intelligence behind about the amount that you want to ask the customer as an initial retainer. Don't ask for 500, maybe ask for 1,000, knowing that there's a disbursement component to that matter. And if you do that, then what that does is it saves you time and reduces the number of steps that you as a legal firm would have to take for that one single file. And imagine, and you have to do the mind calculation and extrapolate the amount of time that you can save, because that's the time multiplied by the number of files and clients and the disbursements that you deal with in a certain period of time. Yeah. So if a good example, and we'll get to this in our next slides, what's a good example for a trust disbursement? But let's get home the point that if you do use the trust account, then all you're doing is when you pay for that disbursement, instead of using the general account, you're pretty much writing a check, for example, right from the trust account. So that same application fee of $260, you're not using your own credit card to pay for it. You are using a trust check, and that money of $260 leaves the trust account directly. Okay? You may want to show that in your statement of ledgers. You don't have to necessarily invoice the client to reflect that, but if you want to, you always could generate an invoice, and the invoice would certainly state that $260 was taken straight out of the retainer or the trust funds, if you will. Okay? And hence, there's no need for you to send the invoice. There's no need for you to wait for a client to pay you, and there's even no need for you to do your own internal bookkeeping of transferring the eligible trust amount. So this is keeping it straightforward, reducing the number of steps at least by 2. If you are paying out of the general account, and that's fine. It is what it is. We just want you to keep in mind of these factors so that you can best recover it in time. First, going back to the retainer or agreement letter to understand when you have signed up for or have agreed to with the client to recover these disbursements. Certain legal firms, as I've mentioned in my previous webinars too, if you have corporate clients, you may, I've seen this before, have a certain preset cycle for when you can actually invoice these corporate clients. Maybe it's bi-weekly, maybe it's monthly. So if you've had disbursements collected over a period of those 2 weeks or a month, then it's important and it's your responsibility to record them, bookkeep them, and have them available with receipts, of course, if asked for, but more importantly, have them available for you to generate the invoice at that particular time period without missing any disbursements that you may have lost, right? So record it, report it, and generate the invoice as per the agreed timelines. Now, if you've paid for this out of your own pocket, so let's say you are, your fax, and I've mentioned this in all my demos as well, and it's a pretty cliched example by now, but it's a good example. If, let's say your fax machine broke down, right, or your photocopy machine broke down, typically those are disbursements that, let's say you've agreed to not charge them, but photocopy machine broke down and you had to run to the closest Staples or Walmart or any of these businesses to actually get 100 photocopies. Yeah. And in that rush, let's agree, for the sake of argument here, that you misplaced your wallet or you left the wallet home and you just got a $100 bill. What am I kidding? $20 bill, let's say. And you take that $20 bill and it's your own cash and you use that to pay for it. And now you have to recover. Of course, $20 is not a lot of money, but principle, it's still money that you have to recover. And if that's the case, even more important for you to stick to the schedule, because now there are 2 bottom lines that are in question here. The bottom line of your business that needs to recover the $20, and then further trickling down is the bottom line of your own individual profit and loss, of that having to trickle down back to you. Okay? So, long story short, ensuring that you have a certain way or discipline recording and bookkeeping these transactions and reflecting them in invoices in a certain stipulated time frame so that you best recover, very important. And we've already discussed this. So it's a very important component. You don't want to surprise your client by sending them an invoice with a single disbursement, at a time period that was never agreed upon, because that sometimes could just simply delay the whole payment process, right? And we've certainly seen that with certain examples serving our clients. And the more it gets delayed, the more it's going away from the certain date in which it should have been recovered. Because let's say you paid for that disbursement in May, but if you're only recovering it in July, then you're pretty much carrying that loss for a couple of months, waiting for that. Until then, you report that on a monthly basis as an expense to your business, right? But still, you recover it as almost an expense to your business. Now, keep in mind that each of these data elements and each of these methods that you take determine the actual document that it gets reflected upon. If you paid for this disbursement out of trust, that's a trust disbursement journal. If you paid this out of general, of course, that's the general ledger or journal. It could be ledger and journal. So it really comes down to the type of method that you've chosen to reflect a certain type of document that it reflects upon, but all of them being Law Society documents that are required. All right, so here's an interesting slide. Often I share this, and I do pause here for a quick minute. There's, of course, as I mentioned before, trust and general, both very good routes to take. Trust, even better if you can exercise that accounting vehicle to pay for disbursements. But in general, rule to keep in mind, if your recovery of the expense of that particular disbursement, let's say, is on the actuals, right? So you paid $250 and you're recovering $250 from the client, not a cent more or less, then of course the trust account is a great example of utilizing for the disbursement. Because you want the trust account to be as black and white as possible. You don't want any anomalies to be reflected, because that often leads to the questioning and leads to having to scrutinize the whole compliance and the audit process, right? Typically, you want to keep your trust account in a very sanity manner. So if it's actuals, general thumb rule we've seen, great to use trust account, of course, and or general. But if you are expecting, for whatever reason, right, a certain component of profit or loss margin, let's say you never accounted for you to have to travel, let's say Sudbury for a matter, but then you had to, last minute, you had to send someone else out, and this has happened as a standby, and of course you need to pay that person. You may decide that that's not something that you had agreed upon on paper with the client, and you know that they're not going to pay for it. So you're pretty much assuming a bit of a loss there, but paying for it from your firm's perspective. If that's the case, then please do utilize the general account. And the same thing happens for profit margins. If you are utilizing, let's say you've purchased a software, and I've seen this where you can spread the cost of that software across multiple matters as they're purchased by file. Sometimes there's a certain profit margin that's included because you've done a lot of negotiation with the software vendor to have purchased it at a lower price based on volume, the volume discount. Okay? So in that case as well, you use the general account as the perfect way to pay for these disbursements. And if it's unit rate or travel mileage, specifically unit rate, if you look at it, 100 photocopies and 20 faxes, we recommend that you use the general account. Okay, as I mentioned before, the pathway that you take and how you pay for this reflects in the corresponding documents. Okay, and we're going to now look at, so hopefully, in the last 15 to 20 minutes of me rambling away, I've either re-emphasized what you already know or have shared something that you've just learned today about disbursements, the need to manage and maintain them right on time so that they best reflect on your books, and also the faster you can recover, the better it is for those time period P&Ls. And an important first step at all of this is to being able to find a certain process, certain discipline to record these transactions as and when they happen. Of course, we looked at the 2 or 3 different pathways that you have, the 2 important financial vehicles that you have, trust and general, and the 3 pathways that you have to recover, either paying for it straight from trust, or maybe you have money in trust but you're paying it out of general anyways. Sometimes you do that for points, airplane points or others, SO points, and then you're doing a trust transfer, an eligible trust transfer. In both of these, the risk of having to wait for a client to pay you without a dispute is reduced. Whereas in the third final pathway, where there's no trust or retainer money involved, and you're paying for it, with the leap of faith that this client would pay you for that money that you paid for in advance, is the third option of paying it completely out of general account. And with that context, we now move into the next phase of how these transactions being recorded with all those details that we discussed, like the date, the time, the actual amount, the particulars in terms of details of who was it for, what was it for, method of payment. Why did they ask you all this, right? And that's what the next 10 minutes of my rambling is going to be. It's going to be talking about these documents called as law societies documents. And again, there's no fear factor associated with it. It's simple, it's straightforward. It's a bunch of 4 or 5 documents, and that's it. So there's ledgers and journals. If you have trust account, you have a trust ledger. If you have a general account, you have a general ledger. You paid the disbursement, right? So let's start with there. And then there are the journals. So if you have trust account and you use that to pay for disbursement, then you use the trust disbursement journal. If you use the general account, then there's the general disbursements journal. Okay. And the last component, I'm just drawing you a quick picture, and we'll go back into each of these documents right away. The third, I would say, data set component. So far 2 documents, 2 here, and this is the 5th. It's the fee book. Now, why is there the fee book involved here? Because in the case where you're not using your trust account, you do include these disbursements as part of your invoice. And the invoice typically relates to fees or money that you're asking for from a client, right? And hence it's almost reflective of revenue or fee, let's call it. And hence the fee book pretty much records not just the fees that are involved, not just your legal fees of billable time, the work you've done, but it also includes disbursements that are all part of that specific invoice, if any, right? Because that also needs to be a part of that invoice, and hence it's part of that fee book. The only difference, of course, is when you're recovering money for your legal fees, it's for the time and value that you put in. But when it's for disbursements, it's for the actual money that you've already spent. Okay, that's pretty much the difference, right? So here's the 5th document, that you need to find a way to record and report on a regular basis. So highly recommended to reconcile on a monthly basis at a minimum, and then generate the ledgers, journals, including disbursement journals, e-book, and expense book, and all of these wonderful compliance documents, at least on a monthly basis if you can. Okay. We have another 25 minutes left in the webinar, and I'd like to take a pause, just a quick minute, before I jump into the actual compliance documents, and pause and ask if you have any questions for me in terms of what we've covered over the last 30 minutes. That way it's a little bit more interactive, a little bit more of a learning aspect to it. So based on everything that I've rambled away the last 30 minutes, please do let me know if you have any questions, and I'll just take a quick minute to pause. Yeah, and please do use the chat window to ask that question. And you can be rest assured there's no right or wrong question. Either I've been extremely clear in my presentation, which I'll take as a great yay. I guess that's what it is. Alrighty then, well, thank you so much for that. I will move on to really talking about the ledgers, the journals, the fee book, and with time remaining, kind of showcase using uLawPractice as an example, of course, just as an example of how best you could generate these documents and what you should expect when you generate these documents in terms of timing, in terms of time and effort being put in to report them. Okay? Of course, we start off with the trust ledger. We'll start there. Assuming you had a trust account, okay, and let's say you used the trust account as a means of paying for a disbursement, you would first and foremost, of course, get the, let's take the second example here of Peter Piper for corporate. You've got a retainer, 565 coming in into your retainer account or your trust account. That's why you see that under receipts. Let me see if I can annotate real quick. Okay. You can see there's money coming into your trust account. That's great. Of course, this example doesn't really talk about disbursements specifically, but keep in mind that there's a column called disbursement, which is really money being disbursed. But this particular invoice of 002, assuming I was raised because this is from a general account. But if this was a trust disbursement, instead of the transfer to general, you would just see, hopefully this is better. Just have to adjust my mic, I guess, a little bit more. Please do let me know if this is better. Awesome. Alrighty, so if this was really a trust disbursement, then what you would see is a line item on the specific date when that trust disbursement occurred. The particulars could be a court fee, and the disbursement would reflect the actual cost of that disbursement, which is, let's say, $260. That's it. And this would say, let's say this is $265, and let's assume for simple math, the disbursement was $565 and $265 is the disbursement. A very important aspect of a trust ledger is a running balance. So on the 5th, the balance was $565, assuming that this was a $265 disbursement for an application fee, you would see a running balance remaining of $300 on July 14th, which means if you draw your trust balances report, you should see $300 still left in Peter Piper's trust account of money being unspent or available for you to repurpose. Okay? That's what you would see as soon as you use a trust disbursement. Straight into the ledger, if there's money coming in, money leaving out. Got it. Now, what if this was a general payment? So let's say you still had money coming into the trust account, okay? But you still have to generate an invoice because you had used the general account to pay for it. Now what? In which case, you do have to raise that invoice. That invoice may, or in this, let's assume it contains fees and disbursements. So the $565 in this case was, $300 of fees and $265 worth of disbursements. You have to generate the invoice. Now this gets reflected not in the trust ledger as a disbursement directly the way you see it, but it's reflected as a trust transfer when that happens in the trust ledger. But it does not stop there. It also adds another item or a transaction line item in the general account. Because to begin with, the money was taken out of the general account. You then did the invoice, and now you've done a trust transfer. So money would have been taken out of the general account, and then money got deposited in the general account from the trust. And the reason why I'm kind of painting this picture and talking loud about these transactions is keep in mind the number of transactions that you need to account for increases as you move away from the trust account disbursement. Okay, if you've paid for this disbursement right out of your trust, there's just one single line item that gets recorded in the trust ledger, and then of course the trust journal automatically, because the details vary in terms of what a ledger has to reflect and what a journal reflects. Okay, that's a different conversation, but keep in mind that you do have just limited bookkeeping to do, let's say that. Now in the case of the third pathway, and we hopefully remember the third pathway was there is no trust account, there is simply general ledgers involved or general accounts involved, then you would see no line item in your trust account. That same $565 would be an invoice that you generate, and it's not a trust transfer, it's just money that you're recovering from a client payment, and that's the name given to that transaction. Okay, so 3 different pathways reflecting in multiple documents in 3 different ways. Now let me move on to the journal. So before I move on to that, let me quickly highlight the data components that you see here within a ledger. As you can clearly see, you have the date, important particular as we discussed for you to capture, the actual details, the particulars of that transaction, what was it for? And what would be nice to have is also who was it for, and that's what you have right up here. This is for Kim Kirby, but you're also being very specific about the matter. So this is regarding the file loan to Taylor. You can see the difference. This is for Peter Piper's corporate. This was different, yeah? And you can see that continues through all documents. Especially disbursements can only be for a specific client. You have the date, the particulars, the amount. There's no taxes discussed here, and there's a running balance. In a general ledger, the difference from trust to general is you do have the tax component of it. Okay, so you can see that, assuming this is not fees, this is disbursement, there's $113. Let's assume that this was an invoice where there was a $113 disbursement. You had generated that invoice, and on the 22nd, the client paid you that invoice, and then you recovered that $113. In this case, you have the jurisdictional tax that you charged them and received. Okay? Trust, there's no HST talk. General, there's HST talk. These are the ledgers. Now, To add to this, you have, well, I hope you can hear me. I think someone's having trouble, so if you wouldn't mind just dialing into the number provided, I'm going to quickly enter that. Bear with me for a second here. Okay. So what's great about the journal? What's so unique and special about this document? Why couldn't it have just been that one single document? And the purpose for that is the journal is now trying to capture a different characteristic of that transaction that's not in your ledger. You can see some similar data elements between the ledger and the journal. You have the date. You have the particulars. They just have a different column name, let's call it. Of course, you have the amount. But you could see that there's a couple of more, columns added to this journal. And the most important one that I see is the method. And of course, who is this paid to? But the method is so important and comes very handy during a reconciliation process. If you've written a trust check, very important for you to capture that it was a trust check to begin with. Because if you haven't recorded that's the method that was used, then sometimes it will be just harder for you to follow the audit trail and reconcile and find, especially if the numbers don't match. So the journal, in addition to the date, particulars, and the amount, also captures the method and who this is paid to. This you can clearly see that this is a payment that was made to self. So Leslie is the actual lawyer here, and she's pretty much paid herself. Okay? Or it's being written to Leslie the lawyer. When it comes to general, there's a couple of documents, the receipts and the disbursements, but I'll just focus on the disbursements. The date, the method, again, very unique to the journal itself, the method and paid to. The particulars, but like all journal documents, you have the amount and the HST split out. Again, long story short, the two major columns that are added in the journal are the method of payment and who this is paid to, whereas in your ledger, you don't have any of that. You just have the date, the details of what was it for, the amount, and the running balance. Whereas in the journal, you see they really don't care for the running balance. Okay? So now you have 4 documents. And the fee book, there's a certain format that's expected out of the fee book. So you have the date of the invoice. When did you generate the invoice? The invoice number, the client for whom this invoice was generated, separating out the fees and the disbursements that were part of that invoice. So for that example that we had of 565, where $300 was for fees and $265 was for the disbursement, you would have the fees, disbursements, and any jurisdictional taxes separated out. Okay? And the total bill. So this needs to be recorded on a monthly basis. These 5 important documents, 2 ledgers, 2 journals, and people. On a regular monthly basis, let's say, so that you can stay on top of those bookkeeping compliance requirements. But at the same time, you're doing justice to your own firm by capturing these details as and when it happens, so that if you're in that position that where you need to recover this money, you're able to do that sooner rather than later. Okay? then the question is, what options do you have in terms of recording it and reporting it? Those seem to be the two major things that you need to do from a process standpoint, right? Maybe multiple options. We talk about legal accounting software. We don't specifically talk about a software. There are many options today. But the reason for you to explore the use of an accounting software, and I've said this many times before, is if you record it and find a way to learn the system and record it within that system, that legal accounting software, the legal accounting software was purpose-built to report and provide you those reporting and compliance document capabilities built right in so that you're not spending time in reinventing the wheel when it comes to those documents. Just a matter of figuring out how you enter the details and record them to begin with in this system. Whereas if you were to write it in an Excel sheet, then you still need to find a way to templatizing a Word document or a PDF to reflect these templates. Okay, so that's really the difference. And the legal accounting software, of course, is also purpose-built to deal with trust and retainer and the trust money itself. But if you're only using general account, then of course, you can also consider accounting softwares to begin with. But being in the legal business, the fact that you have the advantage of being able to utilize a powerful financial vehicle such as the trust, if it's just a mere reason why you're not using it is for the fear factor of paperwork, legal accounting software saves the day if they reduce half of the time that you have to put in by giving you the records and reports and the documents that are meant to be in a compliant manner. All you have to focus is recording it and recording those transactions on a timely basis. Okay? Which you have to do anyway with any system. So that's my quick pitch with regards to legal accounting software. And this is kind of my last primer on why it's best to manage disbursements as soon as possible, because its bottom line affects your profit margin if you don't do so in time. Right? We've seen cases where, especially if it's general account, you've paid for these disbursements ahead of time. That means it's come out of your own business money, right? And if you're unable to recover it, sometimes if you do not generate the invoice in time, certain customers may say, I'm sorry, we'd agreed for you to generate these invoices on time. We've seen this with corporate clients. They sometimes just don't pay you. That's just lost opportunity and lost revenue. It's not even revenue, it's just recovering expenses that you already paid for. So you're saving, if you can do early enough to record and report and reflect, you're saving yourself from it affecting your profit margin. Okay? Alrighty. So again, I'm going to use the next 5 to 6 minutes to walk you through the uLaw platform just as an example of the legal accounting software and showcase to you the ease of generating these documents. Between now and my demonstration, again, if you have any questions regarding today's webinar, please do use the chat window at all times. Let me first log into my system. Oh, a very important fundamental question. What is the title for today's webinar? Let me take a quick recap. Okay, the title for today's webinar is Disbursements Demystified. It's accredited for 1 hour of professionalism CPD credits in the province of Ontario, British Columbia, and New Brunswick. Okay? And if you've just joined us a little bit late, here's the agenda. We spoke about what are disbursements, how best to manage them, utilizing the trust and general accounts, the details that you capture within disbursements, and the Law Society documents that you generate as part of maintaining and record keeping these disbursements. Okay? All right. Okay. So I'm logged into this fixtures account of Roger Moore who is my legal professional, and I'm going to pretty much walk you through the different documents that you can generate. If I move into my monthly compliance, you can see you have the client's trust ledger. And let me say, and of course, you can do this on a weekly basis if you like. I'm going to do this for the monthly. And you can see for this month of May, there's just one line item for one client, Jerry Fishmore. And that's pretty much the trust ledger for the month of May. You've received a retainer of $1,130. There's a trust transfer for a legal fee that was done of $452. So let's look at Jerry Fishmore. Okay, so there's a client meeting. Let's say there's a trust retainer, and I say it was, there was that $265 we spoke about as a trust check coming out of my trust account that I pay. Button, paid from trust. The $265 as a trust check for a court fee paid to the ministry. This could be Attorney General, so I'm just going to say, and you can even print the check, but let's say this is $265 that's going right off the trust account, because keep in mind, there is trust money, and you can see automatically the trust balance reduced from 6 something to 413. Okay. Now if I go back into generating my trust ledger, the same time period, you should see the third line item directly reflected in my trust ledger for that particular, with the date, today's date, the details, and gives you a running balance as the trust ledger should. Okay? And this does not touch the general ledger at all. Let's use that same, with another minute left, use that same Jerry Fishburne. And instead of paying the disbursement, you can see in the matter, you can go in and do your disbursements. And instead of utilizing the trust account, let's say I used my general payment. I could say I used my vacation fee of $365. Now, for purpose of the demo, I'm going to say tax exempt, but this could be anything. And this could be a fax, a photocopy, right? This could be any different type of disbursement. And this is, so I think there's a question about miscellaneous expense, so this is where you can manage that. Or if this is just a photocopy, that someone asked that question, you can do that as well. Now it's a general. Okay. Now you have $20. To recover that, you'd have to generate an invoice, include that 2825 or any other fees that were part of that cycle. But once you've generated that invoice, because there's money in trust, you are able to do the trust transfer of moving the money, the eligible money. So here's where illegal accounting software keeps you compliant, because you can't move any random money. You can only move the eligible money that's you've earned from trust to general, keeping you compliant right to the get-go. 2825. I'm going to say check, but this could be email transfer, any of those different methods. Now for my final document, and I'm going to let you go after this. I go into my trust ledger, and we spoke about a couple of documents. No, in fact, you know what? Let me do the general disbursement. Like that. So pretty much generating the documents once the detail is in is half the job done with illegal accounting software. And you can clearly see with this ledger, in addition to the 265, there was a trust transfer that was moved from the trust account. And where does that get reflected? That gets reflected within the general ledger. And you can see you did not have to generate these documents. You pretty much took the action of recording the transaction within a file for Jerry, and the documents related to that are pretty much captured behind the scene. Okay? And that's the power of the legal accounting software, reducing the amount of time that it takes for you to generate these documents that you need. And what's critical to note is that the component of taxes are included or captured as well. You can clearly see that the 2825 includes a $3.25 tax. Where does that get reflected? Automatically gets reflected in the appropriate HST document, which is necessary for you if you have filed for HST to reflect upon it automatically. So bottom line is utilizing the right system that can allow you to record these transactions and disbursements. A, allows you to recover them in the 3 different ways that you can. Highly recommend exploring the use of the trust account to pay for your disbursements so that you reduce the amount of paperwork, paper trail, and bookkeeping that you have to do to recover that money. At the least, have a retainer, if not completely paying for it using the general account. And last, utilizing illegal accounting software as a legal practitioner reduces the amount of time that you have to spend in generating the Law Society documents, especially being this part of the world, in Canada, where Law Society audits and compliance is taken upon very seriously. Utilizing an legal accounting software is purpose-built, allows you to reduce the time that it takes to report and reconcile these documents. Okay? So with that, I will thank you for your patience, for letting me go a few minutes past time. Have yourself a great weekend, and I will look forward to seeing you, or talking to you rather, next week. Till then, signing off. Thank you so much.